Hello everyone, welcome to Business Education and Research. This video presents the profit maximization objective of financial management, explains why do companies go for profit maximization, special features of profit maximization objectives, the various product life cycle stages and profit maximization objectives, and the challenges of adopting profit maximization objectives. In the context of financial management, profit maximization refers to the deliberate efforts to maximize a business net income or profit during a given time frame, usually a fiscal year. In order to reach the maximum degree of profitability, this goal focuses on optimizing revenue creation, cost reduction, and operational efficiency. While maximizing profits is the main objective, it is important to take sustainability and short-term gains into account as well. This entails keeping a balance between current earnings and prospective future growth, as well as assessing possible risk against rewards. Now let us discuss the special features of profit maximization objective one by one. Profit maximization places equal emphasis on long-term and steady revenue growth. This could entail employing marketing techniques to draw in new clients while keeping hold of current ones. Additionally, reducing the risk associated with depending solely on one source of income can be accomplished by diversifying revenue streams through complementary goods or services. Furthermore, raising lifetime customer value and encouraging repeat business can result from rising customer engagement and customer satisfaction through better customer service or product quality. For example, to maximize earnings, a software company may concentrate on introducing new features or services that will draw in more users and boost subscription income. Companies use cost-cutting techniques such as optimizing resource use, streamlining processes, and negotiating better terms with suppliers to maximize earnings. Lean management techniques can be used to find and fix organizational inefficiencies, which further lowering operating cost. Furthermore, cost-effective solutions can be found without sacrificing quality or service levels by outsourcing non-core operations or implementing shared services models. For example, by streamlining flight paths, increasing fuel economy, and renegotiating agreements with aircraft manufacturers, an airline company can save operational expenses. In order to maximize profits, prices must be set to generate the most revenue while managing cost, taking into account variables such as rival pricing and demand elasticity. Companies can also determine pricing thresholds and modify their practices to maximize income by raising pricing analytics and market research. Furthermore, providing bundled packages or a tiered pricing can promote cross and upselling opportunities, increasing overall revenue of the company. As an illustration, a retail establishment may use dynamic pricing algorithms to modify product prices in response to shifts in demand, optimizing earnings without compromising sales volume. Companies that aim to maximize profits make research and development investments in order to stay competitive, develop novel products and services, and seize new market possibilities. Research and development expenditure may concentrate on enhancing current products in addition to creating new ones in order to stay competitive and satisfying changing consumer needs. Working together with academic institutions or business partners can provide you access to specialized knowledge and resources which can speed up innovation and cut down on developmental expenses. Investing in intellectual property protection such as trademarks or patents can also help to preserve the competitive edge and potential future revenue streams of the business. For instance, a pharmaceutical business invests a large amount of money in research and development to create commercializing those products and realizing large profits. To boost sales potential and overall profitability, profit maximizing businesses investigate new markets, demographics, or geographic areas. Companies must carry out in-depth market research before entering new markets in order to comprehend local laws, customer trends, and rivalry. Furthermore, successful market penetration requires modifying marketing tactics and product offers to accommodate a range of cultural preferences and needs. Furthermore, forging strategic alliances or collaborations with nearby companies can help open up new markets and increase brand awareness. As an illustration, an e-commerce platform goes global in an effort to reach new clients groups and capitalize on developing regions with significant development potential. In order to safeguard profits, profit maximization entails evaluating and effectively managing financial risk, which may include hedging against interest rate or currency fluctuation. In addition to currency hedging, business can reduce risk related to interest rate swings or commodity price volatility by using financial instruments like options or swaps. Moreover, preserving sufficient reserve of liquidity and optimizing capital structure guarantee continuous operational stability and act as buffer against unforeseen financial shocks. To further ensure profitability, proactive risk management and strategic decision making are made possible by routinely stress testing financial models and scenarios. As an illustration, a global company uses financial derivatives like forward contracts to protect its profit margin in foreign transactions by reducing the risk associated with exchange rates. Companies evaluate their progress towards a goal of measuring profit maximization using important financial indicators including profit margin, return on investment, and earning per share. Companies may monitor non-financial measures including employee productivity, customer satisfaction scores, and brand perception in addition to standard financial data. Benchmarking performance against industry peers or best practices also offer competitive benefits and useful insights into areas for improvement. Using data visualization and advanced analytics technologies also allows for real-time performance monitoring and improves decision-making ability. For example, a publicly listed corporation keeps an eye on its quarterly earnings reports, evaluating profit margins and EPS growth to show shareholders that its attempts to maximize profit have been successful. By seeking to raise a shareholders' wealth through dividend payments, capital gains, and total profit growth, profit maximization is in line with the interest of shareholders. Companies need to think about in creating shareholder value and long-term sustainability in addition to increasing short-term earnings. Building trust and confidence in the company's management and strategic direction is achieved through transparent communication and governance standards while engaging with shareholders. Implementing ethical business practices also improves long-term shareholders' value and brand reputation. Examples of these practices include sustainable sourcing and corporate social responsibility programs. For example, a publicly traded corporation puts maximizing profits above everything else in order to draw investors, raise the value of shareholders, and provide dividends and capital gains to its shareholders. Flexibility and adaptability in the face of shifting market dynamics, industry confusions, and economic conditions are essential for profit maximization in order to maintain profitability over the long term. In times of economic uncertainty, businesses could look into alternative sources of income or change their company plans in order to take advantage of new opportunities. Additionally, diversifying into areas or businesses that are less vulnerable to recessions helps lessen the impact of downturns in economy and decrease revenue volatility. Additionally, organizations can swiftly modify operations in response to shifting consumer taste and market dynamics by maintaining an agile supply chain and flexible cost structure. For example, during recessions, a company in the hospitality industry modify its profit maximizing plans by cutting expenses, extending promotions, and enhancing its revenue sources to offset drops in revenue. Now let us discuss why do companies prefer profit maximization objective. To start with, let us discuss about maximizing shareholders' wealth. Since profits are a direct factor in dividend payments, shares buyback, and capital gains, pursuing profit maximization is consistent with the main goal of maximizing shareholders' wealth. For instance, a publicly listed company such as Apple places high priority on profit maximization in order to boost stock performance and raise the shareholders' value through steady revenue growth and profitability. Businesses can generate cash for acquisitions, market diversification plans, and expansion initiatives by optimizing profitability. This promotes business growth and the increase of market share. For example, Amazon uses profit maximization to fund its aggressive market expansion, infrastructure development expenditure, and the launch of cutting edge goods and services. Companies that have demonstrated a successful track record of maximizing profits are more appealing to creditors and investors, which makes it easier for them to obtain outside funds through debt issues, equity offer, or venture capital funding. To attract venture capital investment, for example, a software startup such as Airbnb concentrates on maximizing profits, which drives the company's quick growth and global market expansion in the hospitality sector. Profit maximization enables businesses to provide competitive salaries, incentives, and dividends to stakeholders such as customers, suppliers, and employees in order to reward them and motivate them. For example, a global company such as Coca-Cola uses profit maximization to maximize returns for investors, provide employees with competitive benefits, and uphold solid supplier connections. Companies can invest in innovation, technology adoption, and operational efficiency improvements to establish a competitive edge in the market, set themselves apart from competitors, and draw clients by optimizing earnings. Profit maximization allows for ongoing investment in R&D, data analytics, and talent acquisition to stay at the forefront of the technology industry, as demonstrated by businesses like Google. Meeting stakeholder expectations. By showcasing financial stability, growth potential, and efficient risk management, profit maximization assists business in meeting the expectations of stakeholders such as shareholders, lenders, and regulatory agencies. For example, a financial company such as JP Morgan Chase puts profit maximization first in order to satisfy investors, adhere to legal regulations, and keep it creditworthiness in the banking industry. Successful companies can set aside funds for philanthropic endeavors, environmental sustainability initiatives, and corporate social responsibility programs. By doing so, they can improve their reputation while making a good impact on society. Profit maximization make it possible to invest significantly in CSR initiatives such as community development projects, education campaigns, and environmental conservation efforts, as demonstrated by businesses like Microsoft. EVA, Economic Value Addition, evaluates a company's capacity to provide returns above its cost of capital, boosting shareholders' wealth and overall business success. Profit maximization helps to create economic value addition. For example, NextEra Energy, a utility company, maximizes profits through strategic investments, effective operations, and value-adding projects, a renewable energy infrastructure to provide positive economic value addition. As profitability offers resources and incentives for experimentation, creativity, and risk taking, it promotes entrepreneurial pursuits and an innovative culture within the business. For example, Elon Musk's Tesla is a prime example of this strategy. It places a high priority on maximizing profits in order to finance innovative research in space exploration, renewable energy sources, and electric car development, which spurs innovation in technology and upholds established markets. Now let us discuss the profit maximization objective and various stages of product life cycle. To start with, introduction stage. Stage of introduction. Businesses concentrate on product creation, market analysis, and first market penetration during this phase. In order to build brand awareness and attract early adopters, profit maximization techniques may entail significant investments in marketing initiatives, distribution networks, and research and development. For example, when launching a new iPhone models, a tech company like Apple makes a significant investments in marketing and R&D with the goal of maximizing profits through premium pricing and broad market adoption. Profit maximization objective and growth stage. As the product becomes more widely accepted and customer demand rises, sales and market share climb quickly. Increasing output, developing distribution network, and making investments in client acquisitions and retention tactics are some examples of ways for maximizing profits. In order to maximize earnings through subscription-based revenue models, a software business such as Microsoft, for example, spends in sales and marketing to increase adoption of its cloud computing services. Profit maximization objective and maturity stage. As sales growth stabilizes and competition heats up, attention turns to cutting cost and holding on to market share. Streamlining operations, putting cost-cutting measures in place, and distinguishing products through innovation or value-added services are a few examples of profit maximization tactics. To increase profits, a beverage firm such as Coca-Cola, for instance, uses economies of scale and brand loyalty to lower production costs while keeping prices competitive in developed nations. Profit maximization objective and declining stage of product life cycle. Sales falls throughout this phase as a result of consumer preferences shifting, market saturation, or technology obsolescence. Efforts to maximize profits may include product line rationalization, strategic disinvestment, or investigating niche markets to prolong the life cycle of the product. For example, in order to maintain profitability in the face of diminishing physical rents, a DVD rental company such as Blockbuster may implement profit maximization tactics by cutting operational expenses, offloading excess inventory, and concentrating on digital streaming services. Profit maximization is a fundamental goal of financial management that drives businesses' decisions activities to maximize revenue and profitability throughout the life cycle of the product. Now let us discuss the challenges in adopting profit maximization objective. Because of market saturation and heightened competitiveness in competitive marketplaces, maximizing profits becomes difficult. In the case of smartphones, for instance, manufacturers such as Apple, Samsung, and Huawei comp- compete fiercely with one another, making it challenging for businesses to maintain strong profit margins in the face of ongoing innovation and pressure to lower prices. Profit maximization is challenged by economic downturns, interest rate swings, and geopolitical uncertainties. For example, consumer spending declines during economic recessions, which lowers demand for goods and services and affect business capacity to turn a profit. In order to be competitive, businesses must make large investments in research and development. As a result of disruptive breakthroughs and rapid technology advancements that can make their current goods and services outdated. For example, e-commerce companies like Amazon provide difficulties for established brick and mortar stores, forcing them to make investments in digital transformation and omni-channel tactics in order to stay profitable. Increasing labor, raw material, and regulatory compliance expenses can reduce profit margins and make it more difficult for businesses to maximize profits. Manufacturing firms may encounter obstacles such as rising energy prices or disturbances in the supply chain, which can affect their profitability and production cost. Companies face difficulties in striking a balance between maximizing profits and adhering to moral standards in business and society, particularly in sectors where environmental, social, and governance issues are closely monitored. Businesses in the food and beverage sector, for instance, may need to make investments in ethical supply chains and corporate sustainability programs due to issues with the labor conditions, waste management, and sustainable sourcing procedures. In conclusion, while maximizing profits is still a company's top priority when it comes to financial management, it is critical to identify and solve any obstacles that can stand in the way of this goal. A few of the variables that can affect profitability are technological disruption, market saturation, economic instability, operational limitations, and ethical problems. Nonetheless, business can overcome difficulties and strive for sustainable prosperity. To proactively tackling these issues through creative thinking, cost control, strategic planning, and ethical business practices. Ultimately, to achieve both financial success and long term business resilience and relevance in a constantly changing context, a balanced approach that takes into account stakeholders' interests, long term value generation, and societal impact is essential.